in advance is not written. Obviously in the company, you know what is happening, that we are paying using cash or using the bank account. We assume that we are paying using cash. Okay, so we write 120 here. Okay, and this is done. So less cash and the expense. Okay, same amount, opposite side. Number 7, wages 2,000 paid using bank account. So we use, so we have to pay wages. We write the expense wages, and then the bank account that is decreasing for the same amount. So we write wages as an expense. So the amount is going into the expense part, that is the left side, 1,000. And at the same time, the bank account decreases of 2,000. Then, store rented for a year, starting the 1st of November, annual expense 240, payment postponed. Okay, here we are rent for a year, and we rented the store. We started to use it the 1st of November, but the expense, that is 240, the monetary part is postponed. It means that we will pay next year. Okay, so we have to consider this transaction at the end of the period, because we have to integrate an amount that is not written. Okay, now we don't write something, so nothing to do for the number 8, for the transaction number 8, nothing to write. And we go on. So the number 9, let me see if adjustment, insurance. Okay, yes, okay, we have a general adjustment asked, the insurance, prepayment, rent, actual. Okay, so 9, transaction, payables related to the building are paid using bank account. So the payables here related to the building, they are paid now using the bank account. So we have no more payables, so the liability payables are decreasing, okay, and really they are disappearing because we pay everything, so the full amount. And we have the bank account that is decreasing for the same number, so 3,500. Okay, less money in the bank and no more debt. They are settled paying. Okay, now we are at the end of the period, so we have to adjust the insurance expense and also the rent. Okay, there are the 2 transactions that must be adjusted. So, as for the annual insurance, here is 120. We have to adjust it. So we understand that the proper amount for this period, how much is it? The amount of the insurance expense that is pertinent to this period, the ending period. How much is it? It is 10 per month here, no, 120. So, how much is it, the expense, insurance expense that you would like to see into the income statement of the ending year? How much? 30. It is October, November, December. Okay, 30. So to get this result, we have to rectify this account for the 90 amount. Okay, so 90 here, so this will become 30. And we open the account prepayment for the same amount, 90. Okay, 90 because I want only 30 this period and 90 the next one. Okay, 90 here, 90 here. Okay. As for the store, we have the store, yes, we rented the 1st of November. Which expense would you like to see into the final income statement related to this store, to the rent for the store. How much? It is 240 for 12 months. It means 20 per month. How much? 40. Perfect. November and December. Perfect. 40. 40. Now we have to integrate an account because we didn't open something. So it is the opposite adjustment. Now we are integrating something, writing an account that we call rent expense. Let me open more accounts. So the account rent expense on one side for, as you said, 40. And we write an account that we call accrual. Okay. That is like a future debt, represent a future debt coming from the adjustment at the end of the period. It's like payable liability. So it means that we have a rent expense related to the period, but we didn't pay for it. So there is an arising debt, okay, payable for 40. Okay. So rent expense 40 in the proper part, because we are integrating, we are not rectifying, we are integrating something that was not recorded. And at the same time, we write the related debt or payable, called accruals because it is coming from the adjustment at the end of the period. Okay, done. First line of adjustment. Then there is another adjustment to be done. Interest on the loan, 200. So what does it mean? It means that you have the loan and there are some interest related. You know that when you get a loan from a bank, you have to pay interest on the loan. Okay, so this is the amount of interest of the period. Okay, so, and what are you doing here? Accruals. Okay, so let me see if later you are, okay, interest on the loan. Okay, you're not paying them at the moment, okay, but you know that they are pertinent to the period. They are an expense for a source of money given to you, okay? So it is an expense, so we write interest expense, interest expense, interest expense as an expense 200 on the left side. Okay. At the same time, you use accruals. It's like the debt for the interest. You didn't pay them now. You will pay them. They are another debt, 200, coming from the adjustment at the end of the period. We are looking for, at the end of the period, expenses and revenues to be adjusted or to be rectified if they were paid or received in advance, or to be integrated because they were not taken into consideration until now. Okay. Then we have inventory, 1,800. Okay. You know that we have inventory at the end of the period. It means that, let me see,